I've been a part of hundreds of capital raises, from pre-seed all the way through Series A and beyond. And I can tell you that most founders who get rejected by investors don't get rejected because their business is bad. They get rejected because they don't understand what investors are actually evaluating. VCs look at about 5 to 10 pitch decks every single day, and after seeing that volume, they develop a cold framework they apply to every company when they review them. It's like a checklist, and you need to know exactly what it consists of. Today, I'll break down the 5 things that are on that checklist and how you can use these to make your startup irresistible so you can walk into investor meetings knowing exactly what they're looking for and give it to them. Let's get into it. A business that can return 100x. The first thing investors look for is whether your business is even capable of generating venture scale returns. And to understand what that means, you need to understand how VCs actually make money. Venture capital is built around a high loss ratio. About a third of the investments a VC makes will go to zero. Another third will return maybe 1 to 2 times the money, and then there are maybe 2 companies out of the entire portfolio that return 10x to 100x. So when a VC is evaluating your startup, the question they're asking themselves is, can this investment return my entire fund? Because they know that most of their other bets are going to lose money, and they need the winners to be big enough to make up for the losses of all those other losses. That's why if a VC invests $1 million in your company today, they need to see 30 to 100 million back within 7 to 10 years. Those numbers sound extreme, but that's the math that makes their entire model work. So with that context, here's what actually makes a business fit that model. First is market size. You need a very large addressable market. If your entire market is only worth $1 billion, it's unlikely you're going to reach $1 billion valuation, because that would mean capturing 100% of the market, which just doesn't happen. Investors need to believe that there's enough room in your market for you to grow into the kind of company that can return their fund. Second is scalability. Investors want high margins and low marginal costs. SaaS is the purest form of this because you can add another user at almost zero cost. If your business requires heavy manual labor or physical resources to scale, the economics just don't support the kind of growth VCs need to see. And third is capital efficiency, which means how effectively you can turn $1 of investment into $5 or more of growth. Because remember, VCs aren't just looking for revenue. They're looking for a company that can triple revenue 2 years in a row, then double it for the 3 years after that. That growth trajectory is what gets a company north of 100 million in revenue, and that's the scale VCs need to see. Now, here's the thing. Every founder thinks their startup is the perfect investment opportunity, and that's natural. But when you're on the investor side and you're seeing 5 to 10 decks per day, you develop a distance from that excitement. You start applying a cold framework to every company that crosses your desk. And through that lens, you might have a business that generates solid cash flow, that pays you well and has customers who love you. But if it can't realistically get big enough to be a 100x outcome, it's just not VC fundable. And that's not a bad thing. It just means venture capital isn't the right tool for you. There's the bootstrapper path for founders building products with low cost distribution. There's revenue-based financing and other ways to fund your business without taking on the expectations that come with VC money. Because raising venture capital is a pact. You're committing to tripling your revenue year over year, and if that doesn't sound like the kind of business you want to run, you're better off keeping 100% of your company and growing on your own terms. But if you do walk yourself into a VC meeting, you need to understand this math before you even open your mouth. Otherwise, you're going to waste your time and theirs. Traction that matches your stage. Now, assuming your business model does fit, the next thing investors want to see is traction. And traction doesn't just mean revenue, although revenue is obviously the strongest signal. What counts as traction depends on what stage you're at. If you're pre-product, traction might look like email signups, a wait list, or letters of intent from potential customers who are willing to pay once the product launches. If you have a product, but you're early, traction is customers, user engagement, and early revenue. And at Series A and beyond, investors expect significant revenue growth. They want to see that you're on a trajectory that fits the venture funding track, which traditionally means tripling revenue year over year in the early stages and doubling from there. The important context here is that the fundraising market has shifted. A few years ago, you could raise money off of a pitch deck and an idea, but that era is over. The data shows that while total venture capital dollars being deployed is around the same as it was a decade ago, the number of deals has gone down significantly. That's because later stage rounds are getting bigger and early stage investments just aren't happening as frequently as they used to. So what that means for you is that you need more traction today than founders needed 5 years ago to raise the same amount. I see this every day. Founders who are scrappy, especially in the age of vibe coding, where the barrier to entry for software is almost non-existent. Founders who do whatever it takes to get their app launched and to acquire customers and build distribution get funded. Meanwhile, founders who need their product to be perfect or who pivot every other month chasing shiny objects stay stuck. So if you're very early thinking you don't have the traction yet, there's still a way to show it. You can build a basic version of your product using low code and no code tools. Validate it manually and then raise money to fully automate it after you've proved the concept works. That approach shows investors two things: that you're resourceful and that the market actually wants what you're building instead of them having to take your word for it. Now, if you're a founder who's getting ready to raise and you want to make sure your legal foundation is solid before you start talking to investors, click the first link in the description to book a free consultation with me. I'll look at where your company is right now and help you understand what you need to have in place. Now back to the video. The founding team. The third thing investors evaluate is you and your team. At the early stages, this might actually be the most important factor. When you're pre-seed or seed, you probably don't have a ton of product traction yet. So investors aren't betting on your product at that point. They're betting on whether you and your team are the right people to pull this off. There are specific things that immediately move the needle here. Prior exits are the biggest one. If you've built and sold a company before, that puts you ahead of almost every other founder in the room. It tells the investor you've been through the entire life cycle and you know how to get from zero to exit. Relevant domain experience matters a lot too. If you're building a healthcare technology company and your co-founder ran operations at a hospital system for a decade, that's a massive credibility signal. And then the overall question investors are trying to answer is this team qualified to address this opportunity? They want to look at your team and feel confident that you have the right people in place to actually execute on the vision you're pitching them. If you have a team of 10 developers, for example, at the pre-seed, pre-product stage, investors hate that. The team needs to be commensurate to the stage. Too many people on the team too early and it's overkill. The goal is a lean team, like SEAL Team 6. Every person on the team has a clear role and expertise relevant to the goal and mission of the company, but keep the team light. And this is also where first-time founders need to think carefully about their advisory board. If you don't have exits or deep industry experience yourself, you can partially close that gap by bringing on advisors who do. Get someone on your advisory board who has taken a company from zero to exit in a space similar to yours. That doesn't replace founder experience, but it signals to investors that you're aware of what you don't know and you've surrounded yourself with people who can help. So build a lean team of advisors that makes intros for you and can guide you in overcoming challenges. For example, Ariana Huffington acted as that person for Travis Kalanick, the founder of Uber. She served as a guide and mentor to Travis and acted as his staunch supporter. She taught him meditation and encouraged him to sleep more, as well as move away from a company culture that viewed lack of sleep as a badge of honor. At the end of the day, when there's not a lot of product traction to evaluate, the track record and experience of the founders is what gets investors to swipe right on your deck. And when VCs are looking at 5 to 10 decks per day, having a strong team is one of the fastest ways to stand out from that pile. How you plan to spend the money. The fourth thing investors look for is your plan for how you're going to use the capital they give you. Investors want to see you're going to be disciplined with their money and that it's going towards things that are going to drive revenue growth, customer acquisition, and increase your ARR, because those are the things that get you multiples at an acquisition or exit. Most founders get this wrong by throwing up a pie chart that says a third of this goes to marketing, a third goes to development, and a third goes to operations with some buffer built in. But experienced investors see right through that because it tells them you haven't actually thought about what stage you're in and what that stage requires. How you allocate capital needs to match your stage. If you're pre-seed, you're in product validation mode. You're still figuring out whether you have product market fit. So investors would expect the majority of that money going into R&D, paying developers, and building the technology. If you're raising a Series A, the expectation flips. At that point, you should already have a product that works. So if you're asking for 10 million just to hire a team of developers, that's a mismatch. At Series A, investors want to see the money is going towards scaling the business, tripling revenue, building a sales team, and expanding your customer base. And VCs have specifically said this. They don't want to invest so that founders can pay themselves a salary for another year. And they're skeptical of raising purely for marketing dollars without a clear ROI attached to it. The founders who actually get funded approach this differently. Instead of just showing where the money goes, they tie the raise to outcomes. They say something like, we're raising 1 million to get to 2 million in ARR within 18 months. And that signals two things. They understand where they need to be when it's time to raise their next round, and they've reversed engineered the capital requirement from that target. Path to profitability. The last thing investors are looking for, and this one has become more important in recent years, is a clear path to profitability. This is a shift from how things used to be. A few years ago, you could raise round after round while burning cash, and investors were okay with it as long as growth was there. But right now, a lot of VCs are putting emphasis on getting to cash flow positive. They're actively pushing their portfolio companies in that direction. And I suspect that a lot of this comes out of the turbulence from the SVB crash and the broader market correction. Investors got burned by companies that had no path to sustainability, and now they're much more cautious about it. What this means for you as a founder is that your business can't be entirely dependent on fundraising to survive. Sometimes I talk to founders and I ask them how they're going to make money, and they say they're going to raise 3 or 4 rounds and just figure it out. But that's not a business plan, and investors will not take you seriously if that's your answer. What investors want to see instead is that you understand your unit economics. Can you explain your customer acquisition cost, your payback period, how long it takes you to get a return on every dollar you spend acquiring a customer? Can you show them that at a certain scale, your business becomes self-sustaining? Can you demonstrate that fundraising is a tool to accelerate your growth, not the only thing keeping the lights on? This doesn't mean you need to be profitable right now. It means you need to show that you know how to get there and that the path is credible. So if you're a startup founder who's getting ready to raise investment and you want to make sure you have everything in order before you even start talking to investors, click the first link in the description to book a free consultation with me. I've helped hundreds of founders through this process, and I've seen all the legal mistakes that can destroy a fundraise. I'll look at where your company is right now, identify all the legal gaps and risks, and give you a clear picture of what you need to make sure you raise the most amount of capital with the best possible terms. So again, click the first link below to book your free consultation. And if you want to know exactly how to set up your startup so that investors actually take you seriously when you walk into those meetings, then watch this video next.